What if I told you that global debt isn't a crisis, but a business model? Not an accident, not a failure, but a deliberately engineered system that quietly transfers wealth upward, generation after generation. A machine so old we've forgotten who built it. So powerful, most governments can't control it. And so deeply woven into our daily lives that we mistake it for normal economics. Today, we're opening that machine, and what you're about to see may permanently change the way you think about money, debt, and the people who profit from both. To understand how global debt became endless and profitable, we need to step back, far back, to a time when debt wasn't just a financial term, but a moral one. In ancient Mesopotamia, debt was a relationship between people, farmers, merchants, rulers. When it grew too heavy, kings would simply wipe the slate clean. Jubilee, they called it. A reset, a recognition that the economy should serve society, not the other way around. But as economies expanded, something changed. Debt shifted from a human promise to a mathematical obligation, from a temporary burden to a permanent engine. By the 1600s, the rise of large empires required new forms of financing. And this is where the first gears of the modern debt machine began to turn. Europe's monarchies needed money fast for wars, colonies, and expansion. But the old system, where rulers borrowed from wealthy families, wasn't enough. So a new structure emerged, the national debt, backed not by a king, but by citizens' future labor. A debt so big it could never be fully repaid, and wasn't meant to be. Behind these decisions were bankers, early economists, and political elites who saw something others didn't. A country in debt is not weak. A country in debt is dependable, and dependable nations make dependable profits. We're not even in the modern era yet, but the pattern is already visible. Fast forward to the 20th century. As the world industrialized, so did the financial sector. New tools appeared: central banks, fractional reserve lending, government bonds, international credit markets, the IMF and World Bank. Each tool promised stability. Each tool also tightened the machinery. After World War II, the Bretton Woods system locked the global economy into a dollar-centered framework. Countries didn't just borrow from banks anymore, they borrowed from entire monetary systems. Debt was no longer a lifeline, it was a structure. Here's the twist: the more the world borrowed, the more it needed to borrow. The machine didn't just extract wealth, it reinforced its own survival. Every crisis strengthened it. When countries collapsed financially, they weren't allowed to fall. They were rescued with more debt, restructured with more austerity, stabilized with more dependence. Behind the scenes, the same institutions provided the loans, wrote the rules, and dictated the terms. Governments changed, policies changed, leaders changed. The machinery remained. The most important turning point came in 1971, when the US ended the gold standard. Money detached from physical limits, and debt followed. Now, debt wasn't constrained by gold, production, or even logic. It could expand forever, and it did. What had once been a slow-turning wheel suddenly became a global engine. Banks learned they could create money by issuing loans, literally creating debt. Governments realized they could borrow to finance everything from wars to social programs without raising taxes. Corporations discovered that debt was cheaper than growth and far more profitable. And ordinary people, they were quietly inserted into the machine: mortgages, student loans, credit cards, medical debt, consumer lending. Every layer added new revenue streams for the financial elite. Here's the uncomfortable truth: total global debt is now over $300 trillion, far more than the world can ever repay. And yet, the system demands more. What happens when debt grows faster than the economy itself? We already know the answer, because we've lived through it. The Latin American debt crisis of the 1980s, the Asian financial crisis of 1997, the dot-com collapse, the 2008 subprime meltdown, the European sovereign debt crisis, the 2020 to 2024 pandemic-era borrowing spree. Every time, the story repeats. Banks take bigger risks, debt piles up, something breaks. Governments bail out the system, the public pays the price. The machine restarts, stronger than before. Notice the pattern. Crises don't weaken the debt machine, crises feed it. Each collapse transfers more assets, more industries, more public resources into the hands of those who control credit. The fallout isn't a bug, it's the business model. Politicians love promising solutions, reduce deficits, cut spending, raise taxes on the wealthy, austerity for stability. But these fixes fail for one reason: they don't address the machinery itself. Modern economies need constant growth to survive. Growth requires money. Money requires debt, and debt requires interest, which means, to keep the system alive, someone must always owe more tomorrow than they did today. No policy can escape this equation without rebuilding the system from the ground up, something no nation is willing to risk. The machine isn't broken, it works exactly as designed. Look around today. Household debt is the highest in recorded history. Government debt rises faster than GDP in nearly every developed nation. Corporate debt is at levels economists once considered impossible. The interest payments alone on some nations' debts are larger than their education and healthcare budgets combined. This is not coincidence, it's architecture. Debt expands. Wealth concentrates, inequality widens, and still the machine asks for more. Because the system doesn't truly need repayment, it needs dependence. The purpose of global debt is not to be cleared. The purpose is to extract value endlessly. Takeaway 1. Modern debt is not a temporary imbalance, it is a structural feature that channels wealth upward. Takeaway 2. Financial crises are not failures of the system, but mechanisms that accelerate consolidation and dependence. Takeaway 3. The debt machine survives because money itself is now created as debt, making escape impossible without reinventing the monetary system. If global debt continues expanding faster than real productivity, the machine will eventually hit a limit, not because it breaks, but because people stop believing in the money it generates. When confidence fails, the system built on endless promises collapses into reality. The only question is whether that shift happens by design or by disaster. If you want more deep dive videos exposing the hidden architecture behind our financial world, make sure you subscribe, hit the notification bell, and share this video with someone who still believes debt works the way textbooks describe. This story continues, and you won't want to miss what comes next.